Welcome to Sales Tax and More, your go-to resource for all things state tax related. Now here's your host, Michael Fleming.
Hello, everyone. Mike Fleming here, founder of Sales Tax and More, and today's co-host of the Sales Tax and More podcast, where we talk about everybody's favorite topic, which is, of course, sales tax. And in the spirit of Valentine's Day, we're going to talk about how to fix a sales tax broken heart. But first, let me introduce you to my co-host, who's breaking hearts all the time, Ellie Moffitt.
Hey everyone, great to be here. I'm only breaking the hearts of the general public who have to learn about sales tax issues. It's not fun for anyone, but it is necessary and you can avoid a lot of pain. But before we get started, let's do a quick introduction for Sales Tax and More. We are a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We would love to hear from you and we would love to work with you as well. And Mike, that being said, what are the most common sales tax pitfalls?
Oh, it's breaking my heart trying to figure out, we'll narrow this down to just one or two. There's so many pitfalls that are very common and we see all the time, but I think perhaps if I have to narrow it down, there are two that I want to talk about. The first one has to do with Nexus. And unfortunately, some companies just don't understand where they have this link or connection with the state, where the state's going to require them to do something like collect or pay a sales tax or a vendor's use tax. They don't understand where they have this connection. And that's all Nexus is. It's a connection with the state. So when we're talking about Nexus, there's physical nexus and there's economic nexus. So a lot of companies don't understand this new nexus, which is the economic nexus. Now it's new since 2018, so that's relatively new, but it's almost 8 years old now, and a lot of companies just still do not realize about 50 to 60% are not compliant, and they're not compliant because they think that the U.S. Supreme Court's going to step back in and change it. Well, I just don't think that's going to happen. They may fine tune it, but they're not going to change it. It's here to stay. Or they think Congress is going to step in. Well, Congress passed a law in 1959, the Interstate Income Act of 1959, and that's a nexus law that was passed by Congress. When they passed it, they said, Nexus is so complex and so confusing, this is just temporary. Once we get our arms around the concept of Nexus, once we empower panels and do studies, and we're going to come out with a permanent solution. That was in 1959. This is 1926. That was what, 67 years ago? We still have this antiquated solution on the books. So if you're waiting for Congress, maybe your great-great-grandchildren will get some sort of help from them. But in some instances, we've had a do-nothing Congress for a lot longer than you would realize on some topics, especially Nexus being one of them. So I don't know why people are waiting when they know about economic Nexus. But some people just don't know about it. Here we are almost 8 years into it, and our salespeople are stumbling across companies all of the time, and even their advisors, like their CPAs, that don't understand that their clients could be subject to this economic nexus. So that's number one, understanding where you might have a responsibility for economic nexus. And then the second part of nexus is physical nexus, and it's how third parties, if we have an office somewhere, most of us are going to realize that creates nexus. But third parties, this is the biggest issue that has created more problems for more companies as long as I've been doing business. Um, and the reason I think that is because when we're thinking about how we create a link or connection with the state, we don't often think of what third parties are doing on our behalf. That's just doesn't make common sense to me. So I think that's why this is such a big issue. But if you have someone out there who's doing installations or implementations or credit repair or collections, if they're helping you to establish or maintain a market, then that can be Nexus creating. And it doesn't matter if you call them an independent contractor, a subcontractor, a manufacturer's rep. It doesn't matter what you call them. It could just be a company. You don't even have to put a label on it. If you hire a company to do something on your behalf and the state can deem that to be helping you establish or maintain a market, then that's going to be Nexus creating in most instances. So when it comes to physical presence, that's the biggest issue right there. So Nexus is the number one heartbreaker out there, not understanding what it is. And if a state finds you, they can go back as to the point that your nexus began. It may be 20 years ago. In theory, they can go back that far. And sometimes they try to do that. In practice, more states limit the amount they go back, but even limiting it, it's 7, 8, or 10 years. I don't know of any states that go back 9 years, but lots of states go back 7 or 8 years, and a couple go back 10 years. So that's where the real heartbreak comes in. Your business is going along, you think everything's good, all of a sudden the state finds you and they want the last 7 years of back tax, which could be a substantial amount to begin with. Then they want the added insult of penalty and interest on it. And that could exceed 50, 60% of the actual tax that's owed. So that's a heartbreaker. So that's number one. Number two, let's talk about taxability, a taxability heartbreak. A lot of companies and a lot of accountants are under the assumption that services are not taxable. And unfortunately, that's just not true. We go back to the 1950s, that was more true. But at this day and age, I mean, our economy has changed. It used to be manufacturing based. We're a service based economy now. And the states have lost a lot of revenue because of this change from manufacturing to service. And the states are playing catch up. And every year, more and more states are taxing more and more services. So that's tripping up a lot of companies out there. And I talk to some very smart people, and they'll tell me, well, our state doesn't tax any services. And then I have to go out and list the services that their state actually taxes. So every state that has a sales tax taxes at least some services at this point. And like I said, more and more services are being taxed every year. And again, where the heartache comes in is if you have not been collecting sales tax on your services for the last 7, 8, 10 years, the state's going to, then they find you, they're going to want all of that back tax plus the penalty and interest. So those are the two biggest heartaches or heartbreakers out there that I see, Ellie.
Two biggest heartbreakers out there. Let it be written. Those are just some of the things. If you have questions, you can always reach out to us and ask us more, and we offer consultations as well. But Mike, what should someone do if they've never paid sales tax?
Interesting question. This one, it depends. It depends on a couple of things. It depends on the state, number one. It depends on your exposure, number two. How big is it? Is it material? And it depends on if you want me to tell you what the state says you should do or what companies actually do. So a lot of depends in there. So there are certain states that are more aggressive than others. And if this is an aggressive state and if it's an aggressive state, no matter what your exposure is, you should really do what the state wants you to do. And I'm going to get to that in a minute. If it's a less aggressive state and the exposure is not high, then maybe you ignore it. Maybe you don't do anything because the cost of compliance is actually greater than the cost to comply with the state. Now, that doesn't mean you won't get in trouble if the state finds you. It just means that it would be cheaper for you to pay the state out of your own pocket than to do what the state wants you to do. And you got to pay to get registered, or, time is money if you do it yourself or you hire someone like us. Then you got to file the returns or hire someone like us to file the returns for you. So there's a cost to being compliant. Now, if your exposure is material, then you got to decide. There's three basic ways to get registered. One is registering prospectively. In other words, I'm just going to stop the bleeding. I'm not going to continue to do it wrong. I'm just going to start doing it right. That's not the way the state wants you to do it, but some companies either don't have the mindset to pay it or they don't have the ability to pay those back taxes. So they're just going to start collecting going forward. And in some states, that's okay. In other states, they're going to audit everyone who gets registered. States like Illinois, Minnesota, Arizona, Arkansas, you definitely don't want to try to just get registered going forward because it's not a matter of if you're going to be chosen for audit, it's when you're going to be chosen for audit. But if it's the other states, they usually take you at your word. And while you're not supposed to do it, we see a lot of companies doing it. So you've got to make a decision. Do I want to do it the way the state wants me to do it? Or do I just want to roll the dice and get registered, stop the bleeding? That past exposure doesn't go away, but it gets small. The chance of being found gets smaller and smaller every year. And if you're going to do it the way that the state wants you to do it, there's what we call a historical registration. In other words, you use the date where your nexus actually began. And when you register, the state's going to say, thank you for registering. Now, please give me all of my back tax plus penalty and interest. Now, at that point, you can ask for the penalty to be waived, and a lot of states are going to work with you on that since you're stepping forward. Some states won't. And none of the states, virtually none of the states are going to work with you on interest if you do a historical registration. The next way to do it is if you have a whole lot of exposure going back a whole lot of years, is to register through a voluntary disclosure agreement. And a voluntary disclosure agreement is going to reward you for stepping forward voluntarily. And instead of going back 7, 8, 10 years, however long your exposure is, they'll say, as a reward, we're only going to go back 3 or 4 years. So right away, anything older than that 3 years is falling off. You don't have to pay any of that back tax. And in whatever that period is, whether it be 3 years or 4 years, they're going to generally waive the penalty. And the penalties can be 25% or so. So right away, that's a big savings there. And in a handful plus 1 or 2 states, they'll waive the interest. Like Texas will waive 100% of the interest. The state of Oklahoma will waive 50% of the interest. So all in all, there's about 7 states that will waive either all or some of the interest. So sum up, depends on the state, and it depends on your exposure on how you want to register going forward. The states are always going to say they want you to take care of that past exposure, but does it make a good business decision or not to go ahead and take care of that? It's all going to depend on the materiality. So I think that pretty much answers that question for you, Ellie, does it not?
Yeah, I think so. Are you ready for the next one, Mike?
Yeah, absolutely.
All right. What should someone do if they're not registered in the correct number of states?
Well, this sort of relates to the last question. The first thing you want to do is determine what your potential exposure is. And, if it's not that large, maybe you just register going forward. Maybe you just cross the nexus threshold. And then the correct way is to just register going forward. Maybe it's only the last 8 months. And the exposure is not huge, but it's growing. Maybe you do a historical registration, which is use the actual date of the registration and pay the back tax and penalty and interest and ask the state to waive the penalty. Or maybe if you have a lot of exposure, then you go and do the voluntary disclosure agreement like I was talking about. So the first thing you need to do is get your arms around what your potential liability is. Now, if you need help doing that, we do have a service. We call it an exposure review with a VDA cost benefit analysis. And if you're thinking about doing VDAs, I think that this is very important. A VDA is a great tool and it can save you a lot of money. But just like any other tool out there, it's not a one size fits all tool. And for a long time, this is one of the reasons why I say you shouldn't go to software companies for services. We'll throw Avalara underneath the bus, but they said that if you owed any state more than $500, you need to do a VDA. By the way, we charge you $3,500 for each VDA that we do. And we had people coming to us that were paying $120,000 for, 30 plus VDAs before they even paid a dime to the states. That, you still got to pay some money to the states, whether it be 3 years or 4 years of back taxes. Why in the world would anyone pay $3,500 to remit $500 worth of tax? That just doesn't make sense. I don't know how their salespeople got up in the morning and looked at themselves in the mirror, but that was their policy. That's what they did. And, if people were smart enough to get a second opinion, we got a lot of clients that way because they said, you're taking a logical approach. Avalara is just trying to fleece us. And, we would do this cost benefit analysis. And here's the rule of thumb. If you're not if you're not saving at least as much money as it costs to do the VDA, why in the world do the VDA? So even we have a cost to doing our VDAs, and ours is on a sliding scale. Theirs is $3,500 no matter what, or may actually be higher than that now. But ours, if you're doing one, it's going to be more expensive than if you're doing 40. So that's the sliding scale there. There are economies of scale, and the more you do, the cheaper it will be. So, but no matter what, you still have to be saving more money by doing the VDA than what we're going to charge you. So no matter who's charging you, that's the rule of thumb. You got to be saving more money than it costs to do the VDA. If you're not saving that much money, then you get two other options. Do I just register historically and ask for the penalty waiver? And we can do that for you also. Or do I want to do nothing at all? Or do I just want to register prospectively? So there's 4 options that you can do. And that's what we tell you. We give you what we believe should be done, as well as letting you know approximately how much money is going to be due. Because the other thing is, it's going to cost you $120,000, people would tell them. And they wouldn't mention that each one of those VDAs could be costing them $50,000, $60,000, $70,000, $80,000 because you still got to pay the back tax. So in this VDA exposure review, in this exposure review with a VDA cost benefit analysis, we're also going to tell you if the state fines you, here's how much money you would pay. And if you do a VDA, here's how much money you can expect to pay. So that you'll go into this with open eyes. And sometimes people will say, oh, wow, I'm going to have to break this down. I'm going to do our 5 states where we have the greatest exposure first, and I'll get to these other states later on, because if these states found us, this could be crippling to our business, but I can't afford to do them all at the same time. Some companies choose 10 states, some choose 6 states, some do one at a time. So anyway, great tool, but you got to know when and how to employ it. And this VDA cost benefit analysis is going to give you all of the information that you need in order to make an informed decision on how you want to move forward, and will give you the guidance in how to do it. And if you wish, then we can actually implement that plan for you.
All right. Thank you so much, Mike. I hope that this podcast helps everyone avoid a broken heart. And if you have sales tax needs, and we have a lot of solutions and services, we would love to work with you. We'd love to hear from you. You can reach out to me directly at emoffat@salestaxandmore.com, or visit our website, salestaxandmore.com. And we have an entire series of free webinars and resources on our website that are great to check out as well. Thank you so much.
Yeah, and Ellie, even if it doesn't break anyone's heart, it can break your business, which is heartbreaking. So you work so hard to be successful. You don't want something overlooked like this to potentially put you out of business, or to weaken you to the point where it's a problem. So again, we hope that this has been beneficial, and we hope to see you on the next installment of the Sales Tax and More podcast. Bye-bye.
Thanks for listening. Be sure to hit subscribe and check out all the resources we have out on the web.